Sorry, I needed to unmute myself to make I should know that after 5 years of doing it this way, right? But hey, that's awesome news on the flows front, Derek. And certainly being part of a trust company, we understand there are a lot of outflows just because of needs and distributions and such, and having the ability to have net inflows given that dynamic is, a great accomplishment to say the least.
Yeah, absolutely.
So congratulations. So thank you everyone for attending. I'm Chuck Maggiorato at Country Club Trust Company. My teammates on board are also Chance Pierce, Paul Raculia, and Doug Hacker. Chance and Paul in particular are going to have a couple of comments on the portfolios in a minute or so. But I'll briefly go through um, different aspects of the portfolios, including performance. We'll encourage your questions as well. Morgan, if you could put on the deck, and particularly the second page with the variety of numbers. The one, yeah, that one. Nope, the next one. Perfect. Thank you. So you'll see the numbers here as of the end of the third quarter. Third quarter was good nominally, as you could see, up 6 3/4. However, it was a little bit of a lagging quarter versus the benchmark. I'll talk about that in a minute. Year to date, pretty much the same lag, about 100 basis points, about 1%, a little bit more than that actually. And then on the 1 year number, actually a little bit above the benchmark at 17 and a half, let's say, versus 17.3. Reasons for a lag during the quarter, I would say, are twofold. We had a couple of solutions that we utilized that were a bit behind the market. One in particular that is 100% USCCB compliant was about 150 basis points, percent and a half behind the benchmark. And it's a pretty large position in the portfolio. So that cost us about 0.6% of that 1% or so of drag. And the other thing, and we'll see this in a subsequent page, is that we've had an underweight during the quarter in emerging markets, and emerging markets were up 11% just during the quarter. So that provided, I would say, the majority of the remainder of the drag there. The other thing I'll comment on in regard to the equity portfolio in particular is that year to date, the S&P 500, just is for your knowledge, and you may already know, is up about, or was up about 15% for the first 9 months. And the ACWI ex-US, which is more or less all the international stocks, was up 26%, which is the first time in quite some time that international stocks have outshined our domestic stocks. So on the fixed income front, we're also a little bit behind, but still a decent nominal return for the quarter. Our duration, as you will see a little bit later in the presentation, was right on top of the benchmark, about 3.7 years, and that's up since the last quarter and certainly since the end of the year as well. The dynamic there was that corporate bonds actually had a better overall total return performance than government securities, and our portfolio is more heavily weighted towards government securities for safety purposes. And also the difference in yields between government securities and corporate bonds in particular has been pretty tight. So we gravitated more towards government securities because we thought the risk reward dynamic there lent itself more towards government securities. So, and as you see there, as well in regard to a hypothetical portfolio, if you or your constituent has a 60-40 mix, you would have had about a 4.6 return for the quarter and about a 12% return year to date, et cetera. And those are the relatively weighted blended benchmarks for those two portfolios. I will say before I open it up to any questions on performance that for October at least, the equity portfolio was up about 2.3% versus 2.1 for the benchmark. So we gained about 0.2% back in October. And then in regard to fixed income, that was up about 0.45%, and the benchmark was up about 4.43. So very similar, a little bit better than a benchmark, but very similar. Um, I'll take a little bit of a pause here. If anybody has a question on performance, I'd be more than happy to answer them. Please don't be bashful. All right. Morgan, could you go to the next page, please, which is the construction of the equity portfolio? And in a minute, I'm going to ask Paul to talk about some of the transactions we did during the quarter. But you see here the different categories: domestic, large, and small/mid cap, international, developed, and emerging markets. During the course of the year, we have decreased our allocations actually to the domestic pieces to fund additional allocations to the international developed in particular, and somewhat to emerging. Right now, we still have a slight overweight to both domestic pieces. And now we are equal weighted at close to 20% allocation to international developed, but we're still a little bit behind or underweighted in emerging markets. The benchmark has about a 9% weight in emerging markets. And at the end of the quarter, we were just shy of 7. We've actually added to that a bit so far in the fourth quarter. The one thing additionally I will note here is that you'll see the SMID category at 4.9%. That's actually an overweight to the benchmark, but the IPS guideline, the minimum amount in the IPS is 5%. So we thought we were above that 5% level going into the end of the quarter, but in the last couple of days, things went the other way. So we were a bit below that minimum we were supposed to be at, but early in October, we rectified that and brought it back up to a 5.1% level. So just to highlight that IPS snafu, so to speak, at the end of the quarter. Paul, you want to discuss maybe some of the transactions we did during the third quarter?
Sure, happy to, Chuck. So you can't see it in the presentation here, but we did have a handful of transactions during the quarter. So maybe kind of reiterate what Chuck said. I think the main thing was reducing our U.S. large cap exposure slightly in favor of adding to international developed markets. So we still have an overweight in U.S. Large caps, but did feel like given the strength in international markets and the discrepancy in valuations, that was an area we wanted to at least be equal weight. So that was one of the areas for the quarter. We also have I'll call it a newer solution on the domestic side that we added to. We identified a fairly compliant solution a couple quarters ago that we generally, when we identify a solution, we kind of ease into a position, and we continued that trend this quarter to add to that particular solution that's just a lower cost, very highly compliant solution. So those were the biggies, I think, for the quarter. I'll just quarter to date. So fourth quarter, as Chuck alluded to, continued the trend of trimming domestic large caps slightly, and then add a little bit to domestic small caps or SMID to remedy the compliance issue that Chuck alluded to. And then did add a little bit to the emerging markets, just given the continued strength there and some nice valuations in that area of the market. So I'll just keep it there and see if there's any questions on underlying activity on the equity side.
Thank you, Paul.
Sure.
Any questions on construction or activity? Okay, Beth, excuse me, Morgan, sorry, one more page to the fixed income portfolio, please. So as I mentioned, in this portfolio at 63% of the portfolio, that's the weight in treasuries and other government agencies versus corporates at about 32%. So a pretty hefty weight in governments of various sorts. The duration, as I mentioned, at the end of the year, end of 2024, we had a duration of 3.4 years. At the end of the second quarter, the duration was up to 3.7, which was basically in line with the index. And at the end of the third quarter, it was up to about 3.9, so just slightly above the index. We do have anywhere between I would say $1.5 million and almost $2.5 million of maturities and or calls during the fourth quarter. So we anticipate multiple calls. I think we just got one the other day, actually. So we'll probably have about, let's call it $2 to $2.5 million of this portfolio to reinvest. I'll let Chance talk about some of the things we did last quarter. Chance, maybe talk about what we did, particularly the new position that we added last
Sure.
quarter.
Yes, sure. So to Chuck's point, from the end of second quarter until really today, we've had about $4 million of maturities. Um, Given where the market is, uh, again, to Chuck's point, most of that's gone in government bonds, whether it be treasuries or agencies. We just don't feel like the spread in corporates or credit of any sort makes a lot of sense right now. You might be picking up 50 basis points of spread going into credit securities rather than treasuries. Um, the one place that we did add a position to in the third quarter, it's called the Angel Oak Ultra Short Income Fund. It really specializes in short-term, high-quality, asset-backed and mortgage-backed securities. Just looking at the spreads there and absolute yields there compared to the rest of the bond market, and even that particular part of the bond market compared to itself historically, it seems to be the most attractive part really of the bond market. Um, and I think, our feeling on the reason why the spreads seem to be more attractive are it seems to be more of a technical reason than a fundamental reason. The Fed is usually a big buyer of mortgage-backed and asset-backed securities. They've been letting those roll off their balance sheet through quantitative tightening. That is expected to end soon. Same way with banks. Banks typically buy a lot of those types of securities, and they haven't been the last year or two. Again, would expect that to end soon. So that's was our addition, and it wasn't a huge addition. I think we had about 2.5% of the portfolio in that Angel Oak fund. But like I said earlier, really other than that, still, you know, reinvesting in treasuries more so than credit. Hopefully, at some point, we'll get an opportunity as yields turn away from this historical tight environment that we've seen to be able to pick up some yield in credit, but that just hasn't been the case recently. So
Thank you, Chance.
no problem.
Any questions on the fixed income portfolio? I will note that this portfolio is essentially 100% USCCB compliant. And I should have mentioned it when we were back on the equity page, but at the end of the quarter, it was more or less 97.5% USCCB compliant. You may recall that our mandate is to be at least 97% compliant. So we have been in good shape on both funds for quite some time, which is great. I will make a couple crystal ball comments. Not that crystal balls are ever accurate, but just what we're looking at and more or less in the markets, and then I'll open it up to any additional things that might be on your minds. There are always a variety of things to digest in markets, positive and negative. I'd say on the positive side, inflation, although is in that, let's say, the 3% area is looks like it's been at least mitigated for the time being. Corporate profits continue to be good, including what we've seen so far for third quarter earnings. The economy as such, as you've probably read, it's kind of a barbell approach to our economy. Some people are certainly struggling to make ends meet. On the other end of the spectrum, those that have assets, the wealth effect of the markets being positive, have certainly produced a scenario where people with assets, with some wealth, are still spending, particularly on travel and similar things, experiences. So those are some of the current tailwinds going into the early part of 2026. There are going to be some tax cut aspects that'll probably hit starting in February, and some regulatory items as well that should be a little grease to the machinery. However, the labor market looks like it's having a bit of a I wouldn't call it a rough patch, but at least a little bit of a dry spell here. Also, I think there's still some questions about tariffs. We'll see what the Supreme Court has to say in regard to the ability of the president to direct tariffs at himself. As you know, there was a court hearing yesterday in that regard. But I more or less on that front, the Supreme Court is not deciding whether or not tariffs can be levied. It's the mechanism or mechanisms to do so. So even if the Supreme Court knocks down what the levers have been so far in 2025, it's likely that there'll be other avenues that the administration will utilize to implement tariffs. And the shutdown, as everybody's aware too, the market has acted fairly well to it so far. But the longer it goes on, it may cause some sand rather than lubrication in the machinery. Some of you may have seen today that the Secretary of Transportation, Sean Duffy, is talking about cutting back on flights, given some of the aspects in regard to air traffic controllers and lack of being paid, et cetera. And there are a variety of aspects that may have a little bit of a soft patch result here in the fourth quarter, but hopefully for a variety of reasons, the shutdown will be rectified before too long. The Federal Reserve has had a couple of rate cuts so far this year, may have one in December, but there's a bit of a discussion on that front, maybe a little bit less probability than there was a little bit ago, but still more likely than not, there'll be a rate cut in December, and additionally some rate cuts in 2026 as well. So with that, I'll pause again. Happy to answer any questions again regarding the portfolios themselves in general. Also, as you probably know, Country Club was acquired at the end of the third quarter by FMBO, and certainly happy to talk about questions on that front as well. So anything you'd like to talk about, really. All right. Well, Derek.
I have a question on your equity portfolio.
Sure.
What's your stand on private equity in that?
We don't own any. When we took this over back about 8 years ago, there were a couple of hedge funds in the portfolio. I would say just from that alternative investment experience, I'm not sure if anybody's on the line who was part of CFNEK at that point, but I would just say it was not a good experience by CFNEK. The performance was lacking, and also when we started to exit those, one of the hedge funds in particular put up a gate, so we couldn't get out of it. It took, I can't remember, Paul, probably a year and a half, 2 years to get out of it. So I think there has been a reluctance, given the fact that this, as Derek alluded to earlier, this is a scenario where there are distributions on a regular basis coming out of it. We have kind of stayed away from non-liquid positions in particular. And so private equity typically would be, something like that. So all of the positions that we have, all the solutions we have are marketable, and we could turn into cash within the next day, within basically 24 hours. So we've gravitated more towards those than less liquid options. And as you may know as well, we basically do a rebalance every month. Bobby Venable, who's the financial guru at the at the foundation sends to us a reallocation between the fixed income fund, the equity fund, and also there's a money market fund. And so being able to do that has led us to be more liquid or marketable in our positions as well. So does that, I hope that helps, but if you have a follow-up question, looks like it's Mike, I'd be happy to answer any follow-up question you might have as well. Any other questions? All right. Well, Derek and everyone else, thank you, and I'll turn it back to you.
All right, thanks, Chuck. Really appreciate it, and thank you to all of you who decided to attend today, and thank you for your support. And please reach out to us if you have any ideas or questions over the coming weeks or days, and we will work with you on that. So, anyways, hope everyone has a blessed rest of their week, and we will see you next time. Bye-bye.
Thank you, everyone.